You think recovery means you win. It doesn't. Sales volumes are lifting, credit is flowing again, agents sound confident, that feels like momentum. But prices are not exploding. In rugby, more possession doesn't mean more points. You can dominate territory and still draw. Housing works the same way. We are seeing more listings clear, more open homes, more pre-approvals, yet price growth remains muted. That gap matters. Activity without appreciation traps capital. You pay transactional costs. You take on leverage. You gain no real lift. We've seen this phase before. The markets move, investors move. Equity doesn't. There's a structural reason activity can rise while upside compresses. Most buyers never study it. Westpac's latest economic overview is out. Details are on their website. Kelly, if demand is returning but prices remain flat, who benefits most from this phase of the market?
Well, at this phase of the market, the first home buyer is in pole position because it means that affordability isn't going to race away from them, at least on the basis of our forecasts. Now, we're basically thinking that this recovery is not going to be a housing-led recovery. It's not going to be one of those recoveries where we get 3% growth because house prices are doing 7 or 8%. We think that house prices are going to probably rise closer to 4% this year. And some people would say that's even an optimistic view based on some of the recent momentum we've seen in the monthly housing data. So what that means is that people's incomes will be growing at least as strongly as whatever house prices are doing. The interest rates are still on the lower side. You know, you can still get a 4.5% or 5% interest rate right now. That shouldn't really be a problem for a lot of people. The Reserve Bank has eased the loan-to-value ratio requirements, which means that a wider range of first-home buyers and marginal borrowers can get access to credit. So they're the ones that are really in a great space right now.
If prices only rise 4 to 5%, is that actually underperformance once costs are included?
It could well be. Inflation is not projected to go very low. And on a CPI basis, we've got, I'd say, around 2.5% for the next couple of years. And there are certain categories of costs that are quite relevant for property investors that will be doing more than that. For example, rates from local authorities will continue to rise reasonably quickly. Insurance costs are coming off a bit, so that's a saving grace. But I guess on the income side as well, we are seeing that rents are not really rising very strongly right now.
What mistake would first home buyers regret more, rushing or waiting?
I think they would probably regret waiting, actually, because if the outlook that we're projecting has got any credibility at all, then as we go through the year, there's going to be a growing pool of people that will be looking at the housing market. That might be because they're suddenly finding employment that they haven't been able to find for a while, or just that they've managed to accumulate enough savings that they kind of think that now is the time to jump in. The other thing we have to consider in the housing market, the thing that's really holding back prices rising right now, is that buyers are spoiled for choice. There's quite a lot of stock available on the market, and I'm conscious that that may not be permanently the case. Now, I think what is likely to happen as we go through the next year or so is that demand will gradually eat away at the available stock, so that we will go from a situation where buyers are perhaps spoiled for choice to where maybe they actually have to fight a little bit more with other buyers for the prime properties.
Is that the key reason why there's still a suppression of price growth?
I think so, yeah. I mean, we have actually seen reasonably steady increases in housing credit over the last 6 months or so, coming from both investors and first home buyers. That tells me that on the demand side of the equation, that demand is building, as you would expect when interest rates are relatively low. But on the supply side, we can absolutely see that there's a lot of houses on the market at the moment. We can also see an increase in building consents as well that suggests that builders are actually in the process of getting more houses ready to go on the market. So it's a pretty supply-rich environment out there in the housing market, which has been pretty unusual if you look back in the last, say, 5 or 6 years.
What would need to happen for prices to move sharply, not gradually?
For them to move sharply up, I think that if there was something that caused a relatively fast move in the labour market, because I do think it's the labour market that will be quite important here in determining consumer sentiment and appetites to spend. Um, and if the unemployment rate was to suddenly move down and people suddenly started to feel a lot more confident about the outlook, then you might potentially see a bit of a rush towards that housing market. From there's probably a lot of people out there who perhaps have been sitting on the sidelines. They sort of know that they need to get a house at some point, but don't feel like there's any hurry. If they start feeling like things are moving, then I guess things can change quite fast.
Are investors sitting out because of potential election risk?
Right now, I don't think so. Right now, in the credit data, we see there's a steady growth in housing credit, and indeed, housing credit to investors is the strongest growing segment. That tells me that there is a group of perhaps savvy investors out there that are looking at the interest rates, looking at the supply available, and identifying a long-term opportunity and getting involved.
What regions are structurally advantaged during this cycle and why?
Well, the sectors that are currently advantaged are the ones where the income growth is currently strongest, and that continues to be the South Island and the regional economies, because that primary sector is still pumping along. Commodity prices are pretty good. Population growth is stronger in some of those areas, for example, down in Canterbury, Central Otago, etc. But as we go through this year, as that unemployment rate starts to move, as the lower interest rates permeate more broadly through the services sector, you're going to see a little bit more interest coming through in the urban areas. But I guess my message here, though, is that it'll be a little bit. We're not really expecting to see the market suddenly explode to life and deliver sort of like 8 or 10% house price growth this year. If that happened, then I think that would be a surprise to everyone, and I think it would be a real surprise to the Reserve Bank.
But if you had to pick one housing market metric that signals the shift from grind to surge, it would be jobs.
Yep, it'll be jobs. And then if you want to see if it's actually having an impact on the housing market, I would look at the time to sell a house. That indicator is very correlated with what prices are doing. And for the last 6 months ago, so the average day to sell a house has been stuck around 45 days. Heads down towards 35 days, well then it'll be a totally different story.
Kelly Eckhold, where can we find your reports?
You can look on our Westpac New Zealand website. You can look on Westpac IQ under New Zealand Economics, and you can look on my LinkedIn page, which has links to all of our best reports.
Kelly Eckhold, I was going to call you the chief executive. You're not there yet. You're the chief economist at Westpac. Thank you for your time.
Thanks very much, Craig.
A slow market feels safe. It isn't. Sideways cycles destroy discipline because they tempt people into forcing momentum. Next episode, we go after the labour market because even if housing stabilises, wages might not.